8 Chinese regulators have just signed an order that gives millions of mainland investors 2 years to sell every US stock they own and close the accounts down for good. That is not a rumor spreading on X. It is a published plan dated May 22nd, sitting on the website of the China Securities Regulatory Commission right now. And while everyone in Washington has been applauding themselves for the trade truce holding, Beijing quietly went after the pipes, the real plumbing that lets a saver in Shenzhen put money into Apple or Nvidia or a US Treasury bond. They did not raise a tariff. They turned off a valve. And almost nobody noticed how large that valve really is. Here is what should make you pause. This is not about a few traders. China is holding roughly $51 trillion in household savings, the biggest pool of private deposits anywhere on the planet. And Beijing has chosen deliberately to keep more of it from flowing west. Late May 2026, the trade war was supposed to be easing. Instead, the financial Cold War just opened a new front, and it opened on the battlefield most Americans never think about, where the money sleeps at night. I am Mr. Tom, and if you want to understand stories like this before they reach the mainstream, take a moment to subscribe. It really helps. Now, let me show you what Beijing actually did, because the headline only scratches the surface. Start with the order itself. On May 22nd, the CSRC did not move alone. It brought in 7 other government bodies, 8 regulators in all, 1 coordinated step, and issued what they called an implementation plan for the comprehensive rectification of illegal cross-border securities, futures, and fund activity. Read past the bureaucratic wording, and the meaning is clear. Foreign brokerages that have spent years quietly letting mainland Chinese citizens buy American stocks are being shut out completely over a 2-year window. New money in blocked, new accounts blocked. And at the end of that window, the websites, the apps, the servers tied to mainland clients all go dark. The same day, regulators named names: Futu, Tiger Brokers, Longbridge Securities, 3 of the biggest platforms that gave ordinary Chinese investors a path into Wall Street. And the CSRC did not just punish them, it proposed confiscating their illegal gains. All of them. The market understood immediately what that meant. Futu's US-listed shares dropped about 28% in a single session. Up Fintech, Tiger's parent company, fell around 25%. A quarter of their market value gone in hours because Beijing decided their core business inside China was no longer acceptable. Now, you could call this routine. China likes control. China watches capital outflows closely. And you would be partly right. But here is where it becomes more interesting than a simple regulatory housekeeping story. Back in late 2022, Beijing asked these same firms, Futu, Tiger, to stop signing up new mainland clients. A polite tap on the shoulder. Bloomberg's own analysts pointed out the difference this time, and it is not subtle. In 2022, it was guidance. This time, it is confiscation of all illegal gains, forced wind down of every existing mainland account within 2 years, and a hard ban on any new buy orders during that window. The tone shifted from "please slow down" to "this ends." Why now? That is the question worth sitting with. And the lazy answer, China just hates capital leaving, misses the more revealing one. Think about what a Chinese household account holding US stocks actually does. A saver in Beijing buys shares of an American company through one of these apps. That is Chinese savings, real renminbi converted to dollars, flowing into American equity markets. Multiply that by however many million accounts, and you have a quiet, steady stream of Chinese money helping to lift the S&P 500 and fund the US government through treasury purchases. Beijing looked at that current and decided it is flowing the wrong way. They want that money at home in Chinese bonds, in Chinese stocks, in yuan-denominated assets, not supporting the financial system of the country they are locked in a long rivalry with. And the timing of that decision is not an accident either, because the domestic alternative suddenly looks much more appealing than it did a year ago. Let me give you the numbers because this is where it stops being abstract. The yuan has been strengthening. As of today, the dollar buys about 6.78 yuan, and the offshore yuan recently touched its strongest level since February 2023. Chinese industrial profits jumped more than 18% year over year in the first 4 months of 2026. And here's the part that surprises people. A basket of high-grade yuan-denominated debt, government and corporate bonds together, has been the single best performer among all the major Bloomberg fixed income indexes this year. Better than US Treasuries, better than US investment-grade credit. Even dollar bonds issued by top-quality Chinese borrowers have outperformed American government debt over the same stretch. Sit with that for a second. For years, the pitch to a Chinese saver was simple. Your home market is stagnant. Your property is underwater. Get your money into American assets where the growth is. Beijing is now in a position to flip that script, not just with force, but with returns. The carrot and the stick arrived in the same quarter. The stick is the account shutdown. The carrot is a domestic bond market that is actually paying off, and a currency that is holding its value instead of losing it. So when I hear people say this is purely about control, I think they are only seeing half the chessboard. Control without an alternative is just a cage. Control with a better performing alternative is a strategy. But let me catch myself here, because I do not want to overstate it. 3%. That is the yuan's share of global payments through SWIFT in recent data. The US dollar sits somewhere around 48 to 51%. The euro is around 24. So if anyone tells you the dollar is collapsing this summer, they are selling you a story, not reporting one. The dollar is not going anywhere quickly. Reserve currencies do not disappear in a quarter. The British pound took something like 30 years to hand off the crown from the 1920s to the 1950s. Anyone promising you a dramatic sudden death of the dollar is either confused or chasing clicks. And yet the direction of travel is what matters, not the current position. Because while the dollar still dominates the scoreboard, the second front Beijing has opened is moving quickly, faster than the headline share would suggest. That second front is the payment system, the actual rails money travels on. For decades, if you wanted to move serious money across borders, you went through SWIFT, the Western-controlled messaging network that connects banks around the world. SWIFT is also, conveniently for Washington, a choke point. Cut a country off from SWIFT, and you have half strangled its economy. They did it to Russia. They have tightened the screws on Iran, and every nation watching that happen drew the same conclusion. Dependence on a system your rival controls is a vulnerability. Enter China's answer, CIPS, the cross-border Interbank Payment System. Beijing launched it back in 2015, and for years it was a quiet utility that nobody outside finance paid much attention to. In 2021, it was averaging roughly 350 billion yuan in daily turnover. Background noise. Then came the sanctions era, and the sanctions era was rocket fuel. Watch how the curve bends. By early 2024, CIPS daily turnover had pushed past 600 billion yuan. Then this year, in March 2026, the system broke its own record. On a single day, it processed 1.22 trillion yuan. That is around $178 billion in one day across roughly 42,000 transactions. The average daily value for that month climbed to nearly 50% above February's level. By the end of 2025, more than 1,700 financial institutions worldwide were connected to it. What is pulling them in? Fear, mostly. When Washington signaled it could hit foreign banks with secondary sanctions for doing business with Russia, banks in the UAE, in Turkey, in Central Asia did the math and began shifting settlement to the yuan, not because they love Beijing, but because they are terrified of being locked out of dollars overnight. And geopolitics keeps handing China new customers. The tension around the Strait of Hormuz, the pressure on Iran, every flashpoint where oil meets sanctions becomes a recruiting event for yuan-based trade. Look at the energy trade specifically, because that is the dollar's deepest route. The whole architecture of dollar dominance grew out of oil being priced and paid in dollars, the petrodollar. Until a few years ago, oil settled in anything other than dollars was a rounding error. Now, reports say the share of oil transactions moving to alternative currencies is rising steadily. And in Saudi Arabia, specifically Saudi Arabia, the historic center of the petrodollar deal, the share of oil settled in yuan reportedly reached around 41% in a recent month. That same month, two major Saudi state banks joined CIPS. Let that land. The keystone of the dollar system is quietly testing the exit. Now, fair warning, because I try to be direct with you. CIPS still relies on SWIFT for messaging on more than 80% of its transactions, so it is not fully independent yet. For now, it is more of a complement than a clean replacement. But Beijing just carried out the first major overhaul of CIPS rules in 8 years, effective February of this year, explicitly building toward a platform that can handle multiple currencies on its own. They are not pretending the dependency does not exist. They are engineering it away, one rule change at a time. And here's the thread that ties the savings crackdown to the payment rails. It is all the same project. Keep the savings at home. Build a way to move money that Washington cannot switch off. You are starting to see the shape of it. But there is a third piece, and it is the one the title pointed you toward, and it is the one that has a date on it: July. This July, Hong Kong is scheduled to launch something most people have never heard of and probably should have: a central clearinghouse for gold. The Hong Kong Precious Metals Central Clearing Company, wholly owned by the Hong Kong government, is setting up a centralized settlement system for spot gold trades, modeled closely on the structure London has used to dominate the global gold market for generations. Operational testing this year. Full system launch targeted for July 2026. That is weeks away from when you are watching this. Why does a gold clearinghouse matter? I want to be careful here because this is exactly the kind of topic where breathless people lose the point. A clearinghouse by itself is plumbing. It is not magic. But plumbing is how London held its grip. The LBMA and COMEX system dominated precisely because no rival ever built infrastructure with comparable depth, and nobody had ever built a serious alternative at scale in Asia until now. Stack it on top of what China already put in place. Last summer, the Shanghai Gold Exchange opened its first ever offshore vault in Hong Kong, operated by Bank of China's Hong Kong unit. That was the first physical expansion outside the mainland in the exchange's entire history. And the contracts trading there are priced in yuan, settled in cash, or in physical bullion. They even waived storage fees to attract early participants. Now, Hong Kong plans to expand its vault capacity from roughly 200 tons to more than 2,000 tons within 3 years, a tenfold jump, specifically to handle real physical delivery that sovereigns and major institutions can trust. Connect the dots, and the picture becomes sharper. You have yuan-priced oil deals growing with Saudi Arabia and others. You have a yuan-denominated gold market with real vaults and a clearinghouse coming online in July. What does that combination make possible? It makes it possible, in principle, for a country to sell China oil for yuan and then turn those yuan into physical gold sitting in a vault in Hong Kong without ever touching a dollar. Oil in, yuan in the middle, gold out the other side. A full loop that routes around much of the Western financial system. Is that loop fully built and running at scale today? No, I will not say it is. The pieces are still being assembled, and assembly is not the same as completion. But every single component I just described is real, is documented, and has a timestamp in the last several months. This is not a theory somebody invented in a comment section. It is an order signed by 8 regulators, a payment system breaking records, a vault tripling in size, and a clearinghouse with a launch date. And the central banks are voting with their reserves. The World Gold Council has them buying gold at a pace we have not seen in modern times. Net official purchases ran into the hundreds of tons per quarter, with full year 2025 totals well above 800 tons, and projections showing that pace continuing into 2026. Why would central banks pile into gold? Because gold is the one reserve asset nobody can sanction. You can freeze a country's dollar reserves with a keystroke. They did it to Russia. They froze hundreds of billions. You cannot freeze a gold bar sitting in your own vault. Gold does not have a counterparty who can say no. In a world where money has been weaponized, the oldest money on earth suddenly looks like the safest. So here is where I want to slow down and ask the harder question, the one that separates analysis from hype. Does any of this actually threaten the United States? Or is it the kind of thing that sounds enormous on a thumbnail and turns out to be marginal? The honest answer is that it sits somewhere in between, and which way it leans depends on things that have not happened yet. The case for it being marginal is strong, and I respect it. The dollar's share of global reserves and payments still dwarfs everything else. The yuan is not freely convertible. China still controls who can move money in and out, which is exactly why people hesitate to treat it as a true reserve currency. You cannot have it both ways. You cannot maintain tight capital controls and also be the world's open reserve currency. The very crackdown we opened with, forcing savers to stop buying foreign assets, is itself proof of how unfree the yuan still is. That is the contradiction at the heart of China's ambition. Trust requires openness, control requires walls. Beijing wants both, and you mostly cannot have both. But the case for it mattering is also strong, and it does not rest on the dollar collapsing. It rests on the dollar becoming optional. The strategic goal, when you read how analysts describe it, is not to make the yuan the new king. It is to build enough parallel infrastructure that the dollar becomes one choice among several rather than the only road. And that is a far more realistic goal. You do not have to win the war to alter its terms. You only have to give the world an exit so that the next time Washington reaches for the sanctions lever, more countries have somewhere else to go. Think about what that does to American power over time. A huge amount of US leverage, the ability to enforce sanctions, the low cost of borrowing trillions, the privilege of issuing the currency the world needs, flows from the dollar being indispensable. Make it merely dominant instead of indispensable, and you have not toppled anything. But you have quietly drained pressure out of the system. It is not a heart attack. It is a slow erosion. And erosion is harder to fight precisely because there is no single dramatic moment to rally against. There is something else underneath all this that I keep coming back to. The most important word in the May 22nd order might be the quietest one: redirect. Beijing is not just blocking money from leaving, it is channeling it. $51 trillion in household savings is a powerful tool if you can aim it. And that is the part Americans should actually study. Not fear, but study. China is treating its own citizens' savings as a strategic resource to be deployed. Keep it home. Point it toward domestic bonds yielding more than treasuries. Point it at a yuan that is strengthening. Build the rails and the gold backstop so that eventually the rest of the world has a reason to want yuan too. Every piece reinforces the others. And the United States runs almost the opposite model by reflex. Open capital flows. Money goes wherever it gets the best return. The government does not tell you to buy treasuries, it just hopes you will. For decades, that openness was a strength. It is why the world parked its savings here. The uncomfortable question is whether in an era where your rival is treating finance as a coordinated instrument of state power, the open model is a strength or an exposure. I do not think that question has a clean answer yet. I am not sure anyone does. Let me bring it back to earth, to what you can actually watch for, because I would rather give you tools than predictions. Watch CIPS volumes. If they keep breaking records and the share of transactions still depending on SWIFT starts to fall, that is the dependency being engineered away in real time. Watch the Hong Kong Gold Clearinghouse after July. Does anyone actually use it? Do the vaults fill? Do sovereigns route trades through it? Or does it sit there empty as a prestige project? Watch the yuan's payment share, 3% today. If that number starts climbing past 5, past 7, the slow erosion has accelerated. And watch whether other countries follow China's playbook of corralling domestic savings, because the idea can spread. What you should not do is panic. I have watched too many videos this week alone shouting that the dollar dies in July, that your savings vanish, that it is over. That is noise, and noise is expensive. It pushes people into dumb decisions with real money. The dollar is not dying this summer. What is happening is slower, more patient, and honestly more interesting than a collapse. It is the building of an off-ramp, a world where brick by brick the dollar's monopoly becomes a dollar majority. And a majority is a far weaker thing to build an empire on than a monopoly. There is one more layer I keep turning over, and I will be honest that I do not have it fully settled. We tend to assume China holds all the cards here, coordinated, strategic, patient. But every move I described also carries a cost for Beijing. Forcing savers out of foreign assets means trapping them in a domestic market that is wrestling with deflation and a property hangover. Building payment rails that route around the dollar invites the very retaliation that could isolate them further. Strengthening the yuan makes exports more expensive at the worst possible time for their factories. Every wall they build to keep money in is also a wall that keeps confidence out. So, I do not think this is a story of a master plan unfolding flawlessly. I think it is a calculated bet, a large one, with real risk on Beijing's own side of the table. They may be wrong. Strategy and certainty are not the same thing. But the bet itself tells you something true regardless of whether it pays off. Beijing has looked at the next 10 years and concluded that financial independence from the United States is worth real economic pain to achieve. They are willing to trap their own savers, slow their own exports, and provoke their own rival to get there. You do not pay that price for a side project. You pay it for something you think is existential. And when your biggest economic rival decides that getting out from under your financial system is worth bleeding for, that is worth understanding clearly and calmly before the screaming headlines arrive. Because they will arrive. They always do. Right after the moment when paying attention would have mattered most. I will leave you with the question I cannot fully answer myself, and I would rather hand it to you honestly than fake a neat ending. If a country decides its citizens' $51 trillion in savings is no longer yours to borrow, builds the rails to move money without your permission, and sets up a gold vault to settle the difference, at what exact point did that stop being someone else's economic story and start being yours? This is Mr. Tom. I will see you in the next one.